For many people, ARCC Capital is a great way of boosting their average dividend yields. As of right now, the yield is hovering around 9%. And let's be real here, that's a pretty insane number. And to be honest, since I added this stock to my portfolio a couple of months ago, I really enjoyed it. The stock is trading sideways year to date, with lots of ups and downs, which are all great opportunities to add more shares if you believe the stock is undervalued. And it is very important to keep a close eye on these stocks when you have invested in them, because as soon as that dividend gets cut, you're in big trouble. Lucky for us, the recent earnings were pretty solid, but more on that in a minute. Looking at the 5-year return including dividends, we see that they underperformed the S&P 500 by quite a margin. But for most people it's more about generating cash flow than having a high appreciation. And in the end, 80% is not that bad after all, especially since they were pretty close in beating the S&P 500 a few times. Looking at the highlights of the recent earnings, we see that net income per share was reported at $0.52. This is actually a pretty heavy decrease versus the first quarter of 2024, and also year over year. Core EPS is looking pretty solid, and so is the net investment income per share. So dividends are covered pretty easily, but you want to keep an eye on these numbers. The net asset value per share was reported at $19.61, a decent increase year over year, and also a minor increase versus the first quarter of 2024. The debt to equity ratio is reported a little over 1, which is not too bad, but it is increasing versus the first quarter of 2024, so that's something to keep your eye on. The unsecured debt to total debt is decreasing versus the first quarter, so that's something I really like to see here. Other numbers look pretty solid as well. In this graph we see again that dividends are covered pretty easily, but as said earlier you want to keep an eye on this number. Also, since the dividend itself isn't growing currently, which is all good since the yield is already at 9%, so there's no real need to increase it. Expenses are decreasing a little bit, mostly because of the capital gains. Down the line, this results in a higher net investment income. And for me, it is really important that companies like ARCC are very well diversified, since it is considered a higher riskier investment. We see that the biggest investment is a little under 8%, which is really good. I want to see a maximum of 10% here. The top 15 investments make up for 27% in total, which is also a great number. So to me, this looks really good. Looking at the industry breakdown, we see that they heavily invested in software, healthcare and commercial and professional services. In total, this makes up for almost 50% of their portfolio. I would love to see this software investment size a little smaller in terms of ratio. But from all these industries, I do think software is having the most potential in the future. So it's not all bad what we are seeing here. Looking at the backlog, we again see that software and healthcare are the biggest. So it's not expected that this number will decrease anytime soon. I do like it that insurance is also pretty high on this list. And now that we know a bit more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. ARCC Capital is a 12.9 billion market cap company. PE ratio is at 7.65, indicating they are undervalued. And later in this video I will show you my 3 price targets for ARCC Capital stock. So make sure to watch until the end, because these price targets might surprise you. And revenue is at 1.86 billion, And in this graph, we see that revenue went up in the long run at a pretty steady and consistent pace. Both the operating margin and net margin are going up and down a lot. But as of lately, trend is upwards again, which is a positive sign to me. EPS is also going up and down quite a lot. I would love to see a bit more steady in pattern here. But it has to be said that companies like ARCC tend to have more fluctuations in their EPS growth. Analysis expect that EPS is going to decrease from here, which is very interesting. So let's keep an eye on this number. For the revenue, analysis expected in 2024 Harris Capital will grow about 11%, but in 2025 they expect revenue to stay flat. Again, really interesting numbers. Return on assets is sitting at 7%, which is a decent number. Return on equity looks really good, and since this is a finance company, there is no return on invested capital to report, and we focus on the return on equity here as the most important number. Current ratio is at 1.4, which is a great number. It's also pretty steady historically, so this looks good to me. And right now, ARCC Capital has 13 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. ARCC Capital has 600 million in total cash, so they can't pay down a big chunk of their debt. To me, this doesn't look good. And it has to be said that companies like ARCC tend to have more debt than other companies. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is looking really terrible in the past couple of years. There are a few positive numbers here, also the most recent one, but to me this could be a big problem. Shares outstanding are increasing over a longer period of time, and I prefer them to go down, but in the case of ARCC it makes sense since they increase shares to raise capital and grow the business. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 9.2%, which is a great number. Annual payout is at $1.92 and payout ratio is at 80%. I prefer 50% or lower. So right now they have only 20% left in cash to buy back shares, pay down debt, do acquisitions and all other things. It has to be said that companies like ARCC it is very common to have a higher payout ratio given their dividend yields. And now it gets really interesting. The 5-year growth rate is at 4%, which is a decent number. And they have increased the dividends for 3 years in a row, which is really nice. And if you take a look at these numbers, the dividends paid since 2014, you see that ARCC Capital did increase the dividends at a decent pace historically. But in 2020, they decreased the dividend due to lockdown periods. From there, they started increasing them again. And payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that historically it looked pretty good. It is coming down, which is the thing I like the most here. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to slightly increase from here. And overall these dividends look really interesting to me. But how about the historical returns? I decided to compare ARCC stock with the overall market. In this case, the S&P 500. Next to that, I added OBDC and Main. On the 5-year chart, we see that ARCC stock was beaten by the S&P 500 big time. In total, ARCC Capital returns 80%. And keep in mind, this is including dividends. The S&P 500 is sitting at 115% return. Both Main Street and OBDC had much lower returns. On the 1-year chart we see that things are changing drastically with 36% return for Main Street and the S&P 500 is second with 29% return. Both ARCC and OBDC have much lower returns here. On the 6-month chart, it is again Main Street together with the S&P 500 having the highest return. This time, ARCC was at least close to beating the S&P 500. On the 1-month chart, it is again the S&P 500 that's winning here. And bottom line, Harris Capital was beaten by the S&P 500 in the long run and in the short run. But could this be the perfect time to buy ARCC stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm putting in 88, 90 and 92. For the free cash flow margin, I'm putting in 10, 12 and 14. For the PE ratio, I'm putting in 6, 7 and 8. For the price to free cash flow, I'm putting in higher numbers. My desired annual return is 15% since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. And right now, Harris Capital stock is at $20.8. I hit analyze, and we see a few green numbers. And I'm more focusing on the multiple earnings value here. We have a low price target of $21, we have a mid price target of $25, and we have a high price target of $30. And to me, the mid price target is the most justified here, telling me that this stock is undervalued based on that number. Which price target do you think is the most justified? Let me know in the comments down below. My final conclusion on Harris Capital is that it is a high risk and potentially a high reward company. There is no denial in dividends being awesome. Looking at the fundamentals, you're going to find a few problems, such as debt and free cash flow. But other than that, it looks really good to me. As said a second ago, dividends are amazing, and that's how I look at this company. A pure dividend income play. I'm planning to expand my position anytime soon. And for me, it is the same strategy that I have with ABR. Another high risk, high reward stock in my portfolio, and I keep them under 5% of my total portfolio. What's your take on ARCC? Please let me know in the comments down below. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.